Back to the UK then, with some dynamic growth action from Greggs. So the stock this week fell 15.5%, which is quite a lot for a UK stock. It's down 37% since the start of the year. They have released their preliminary statement of full year results for, well, basically the year just gone to the end of December. Revenues came in at 2 billion, which was up 11.3% from the year before. Like-for-like sales were 5.5% higher than the year before, so comfortably ahead of inflation, CF, B&M European Retail Value. And people look at that and saw the stock going down. I mean, it was probably down around 13% or so on the day, and said, what the hell is going on here? This makes no sense. That's actually quite strong growth. Why is this stock going backwards? The market's being irrational, and so on and so forth. Not so fast is my general view here. I mean, here is one problem with the idea that it's crazy for the stock to go backwards on that announcement. Partly that's not the most recent announcement. That was announced on January the 9th in their Q4 results, where they told you what they'd done in the full year. So the market already knew that revenues were up 11.3 billion and 5.5% like-for-like sales. They did give you some more information, though, for the full year prelim stuff. They said operating income was up 13.2%, EPS was 149.6p, which was up 11%, and the dividend was 69p, so up another 11%. So roughly in line with all the revenue stuff, more or less. The headline revenue, not the like-for-like bit. I think the market might well have been expecting that. The 11 or so percent revenue growth would have been matched by similar-ish operating and earnings per share growth as well. So I don't think that's a reason that anything in the market would have been reacting to. Good to have that clarified, I guess, but that didn't strike me as news, and anyone who had been following the stock since at least the start of the year, when it started going down rapidly on January 9th, might have remembered they were seeing the same figures coming out there, because one of the first things they said in their Q4 report is that this is what this takes us to for the full year. Okay, so what's new in this report? Well, they gave you a trading update for the first bit of 2025, calendar year 2025, and they said that like-for-like sales were up 1.7%. 1.7%. This is a company then that has seen its like-for-like sales go from about 11% to 5% to now 1%. That is below inflation, which means in real terms, this company is pulling less money in than it was before. That ain't good. We'll come back to that thought in a minute, but I don't see any way that's a good thing. Like-for-like sales growth slowing that rapidly. They are, so if you're not growing by selling more stuff out of your stores, you better open some more stores in that case in order to keep growing, or put up with your share price going down, or in this case both. But they guided for 140 to 150 new openings this year, and that's within either side of 5%, basically, based on their current store base. Trouble is, last year they opened 226 new stores. That was 9.4% on their current base back then. Obviously, the base was smaller back then. So 226 made for a sort of just under 10% growth. They're now looking for just under 5% growth. So that's slowing down as well. The target is around, they say, well in excess of 3,000, which is, they're within 15% of that at the moment. So opening more stores isn't the long-term answer for Greggs. It might be the short-term answer, and it might be that something else is the long-term answer. I'm not against this, actually, as a stock at the moment. But what you will note is that eventually they're going to stop opening new stores, and from there it will come down to like-for-like sales growth going forwards. And what this latest update shows, at least to my mind anyway, is that this is not necessarily as resilient as people might have imagined. 1.7% growth is not even inflation level growth. And one of the things about Greggs is it's supposed to hold up fairly well in a downturn. It is holding up, but it is not moving forward. And so their PE has now been cut down to about 12 on trailing numbers. And they reckon they're going to grow, let's say, 8%, but sort of 5% of that's going to be kind of organic this year, and the rest will be offsetting inflation. 5% is going to be through opening new stores, and the rest will be offsetting inflation. I sort of think that's about right in this case, Steve. I think this was a pretty disappointing set of updates here. That being said, someone on the Trading 212 forum did point out to me, in fairness, management has said that they think they can navigate these headwinds and stand behind their guidance for the full year 2025. And if you believe them, then this does look like a bargain and there's room for optimism. And not every management has said that, by the way. Diageo, we talked about a couple of weeks ago, have pulled their guidance back in because, well, they're citing tariff fears, but you can put that down to any number of things. So I think what you should make of this is it's down. I actually think when I said this to you, I saw this before the market opened, and I said to you these results look bad to me, and it got hammered. You said it looks. I said 8% down. I think it's still a fraction high. It then got to 13 down. You said you think this looks might be worth a look. I have to say I kind of agree with you on this. I think I wouldn't object to anyone buying this in terms of a long-term investment and thinking there's enough of a dividend to keep me going here. I can see my way forward. Actually, at this price, there isn't much built in the way of growth here. Kick that store count up by 15% to get you to 3,000 and then just manage it in line with inflation. We'll be getting something like a 10% yield or so in total in terms of free cash. And that can work from this point. I don't object to anyone buying it here. But if anyone's confused about why the stock went down earlier this week, I think the reason is that their sales growth has gone terrible.
Yeah, there's a couple of things I'd add to that, Steve. They're just going to start off with this first bit, which I found really funny. Was I always think some companies they get a bit like above the station, they get a bit sort of deluded about their position in the world. And the Greg statement starts off by saying, "Looking ahead to 2025, the macroeconomic landscape remains tough. Inflation remains elevated, and many of our customers continue to worry about the cost of living." After years of financial anxiety, they are still facing concerns about energy prices and increased mortgage and rent costs. I'm not being funny, Steve. They sell meat pies and sausage rolls. I mean, it's correct, but at the end of the day, I mean, it's always best to focus on what you actually do rather than some kind of weird economic take at the top of it. And of course, it's there to hide the fact that they've not had a particularly special time as we've come into the beginning of this year. And they've blamed some of it on bad weather, Steve. And, you know, if you wouldn't want to queue outside of a Greg's if it's raining, I guess, you know, you really take that however you feel with that. The issue is that like-for-like sales growth is at 1.7 and cost inflation, they reckon is going to be about 6%. And that's way, way, way in advance of the like-for-like sales growth. So at that point, you'll be opening stores, which they want to open about 150 of in 2025, and obviously not doing as well as they could be, Steve. Now, I just want to sort of like say like when we're talking about like-for-like sales growth, it's important because it's basically talking about how economically the store is ran. So if you, for instance, one of the big ways that you could improve a Greg's, or they did improve a Greg's, was when they queue, you'll notice that you have things to the left and right of you. You're almost queuing around the food, and there's an encouragement there for you to pick something up rather than just going in for your sausage roll. You might pick up 4 yum yums and a drink. That's one of the things they've done to try and improve their like-for-like sales. These things aren't always going to make a massive difference, but they are there to make the customer spend more. So if you think Greg's is the most economically run company in the world and it couldn't possibly make any improvements to its efficiency or the way it sells things or the way it offers things, then pricing is the way that it would grow its like-for-like sales. Now, JKR did say that he thought that pricing was essentially all like-for-like sales increases are. We would disagree with that. That's not the only input you have. Doing things more efficiently is definitely one of the best points of like-for-like sales, which is why Steve and I absolutely adore it as a metric for retail sales, because we need them to look at that and look at the inputs and say, is this company doing all it can to improve its like-for-like sales? And at the moment, we're looking at Greg's here and saying that's a worry. That's maybe an amber flag. It might be a red flag, Steve, in the with what's happening. But it might be the weather, Steve. It might be the financial anxiety. It might be the energy prices going up. It's very difficult to say. There are a lot of inputs going on at the moment. And I think we need to wait and see. There's people who will be brave. There'll be people look at this and say, this is it. This is where I buy. It's about 50% down, probably year over year. it looks at a decent price. It's probably, if you're thinking in a bet, it's probably worth the punt, because even if it continues to go wrong, you ain't going to lose as much as you did at the beginning. You ain't going to lose at your 3000p point that you was this time last year. That would have been a silly bet to take. But here, it might be worth a go, Steve.
Kind of, I agree with you on all of those things. So in terms of like for like growth, I mean, revenues are a function of two things. They're a function of how much you sell and how much you sell them for, basically. And you can push either of those higher, in theory, at any rate, to boost your like for like sales out of your shop. The weather you mentioned twice here, and I have two views on this sort of thing. I've seen quite a few companies now mentioning the blooming weather as their reason for terrible results. Associated British Foods mentioned it. We covered it on this show. B&M European Retail Value are always mentioning it, and we've covered that a couple of times on this show as well. I have two thoughts about this. One is that I understand that the weather is actually, if you're a high street business, which Greg mostly is, they do sell things into schools and so on and so forth, or provide stuff into schools, in fact, and so on. But they're mostly high street based. Yes, I understand that when it's smashing down with rain, people don't want to go shopping on the high street. I get that. And that's true whether it's Greggs or Primark or anywhere else. However, we are in the UK. It's going to rain here quite a bit. You have decided to build a retail operation in a country where it rains quite a bit. I'm happy to admit that's something you can't control, the weather now. However, it does seem to be a durable worry about your... But the more you tell me that's the reason you underperformed, the more I worry about you, basically, because I don't think there's anything you can do about this. When I write pieces for Motley Fool's free service, we're always required, in the name of balance, if we're positive on a stock, to talk about at least one risk of owning it. And it's got to be a company-specific risk, not it's expensive or it might go down or there might be a stock market crash or something. That's true of like any company. I've never thought before to mention it's a retailer based in the UK and it rains a lot about any of these things. But maybe I should in the future. I'm always surprised at how much the kind of bad weather appears to affect these things. I thought it made more sense for something like Primark, where if it don't rain as much, well, then you don't manage to sell as much waterproof gear as you perhaps thought you would in October or something. Or if the weather's dreadful over the summer, t-shirt sales are lower and you've got to try and shift your inventory to try and match the season that you're in. And I understand Greggs does a bit of that, but not quite to the same extent. And I'm definitely a large amount of their kind of range doesn't change in this way. So, yeah, I was not impressed by this report from Greggs, but I think that falling stock has probably put it in an area where I wouldn't argue with someone who was thinking of buying it, Steve.
Yeah, and I put myself squarely in that camp, Steve. I think there's really only two places it goes from here, Steve, is that these like-for-like sales improve because we have a bit of sunny weather, or these like-for-like sales stay the same, the stores drag that revenue up a little bit, and I reassess the position in like 9 months' time and think, perhaps, maybe that needs another 12 months, or maybe that's just the end of Greggs as a growth engine. I think that's very unlikely to be the case, though, Steve. So yeah, I am quite tempted by this one. Maybe it's one of those stocks that in April we'll have to see where it is and think about what we're going to do with it.
That's not so far away. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.